They said the system was too advanced to collapse. They said modern finance had evolved beyond panic, beyond risk, beyond human error. And yet, in 2008, the world's largest banks, armed with algorithms, arrogance, and endless ambition, brought the global economy to its knees. Fortunes disappeared, homes were lost, governments trembled. And behind it all, one simple force, greed, drove humanity toward its most expensive lesson in history. But the real story? It didn't start in 2008. It started decades earlier, in quiet boardrooms and policy meetings where no one imagined how fragile the system had become. Today, we revisit how it happened, how greed crashed the world, and why, even now, we may be repeating the same mistakes. To understand 2008, you have to rewind to the early 1980s. The world had just survived the oil crises of the 1970s. Inflation was rampant, interest rates were high. Then came a revolution. Under President Ronald Reagan in the United States and Prime Minister Margaret Thatcher in the United Kingdom, a new idea took hold: deregulation. Banks were promised freedom, markets were promised efficiency. And risk? Risk was something clever men in suits could manage. Government isn't the solution to our problem. Government is the problem. That mantra reshaped global finance. For decades, strict boundaries had separated investment banks, commercial banks, and insurance companies. Guardrails meant to prevent the kind of speculation that led to the Great Depression. But one by one, those walls came down. In 1999, the Glass-Steagall Act, the law that kept banks safe from their own greed, was repealed. Suddenly, banks could gamble with depositors' money. And gamble they did. By the early 2000s, the dream of home ownership had become the new American religion. Everyone wanted a house, and Wall Street found a way to make that dream profitable. Enter the mortgage-backed security, or MBS. Here's how it worked. A local bank lent money to a homeowner to buy a house. Instead of waiting 30 years to get paid back, that bank would sell the loan to a larger institution, which would bundle thousands of those loans together and sell them as bonds to investors around the world. It seemed brilliant. Everyone got paid, risk was spread out, and the system looked invincible. But there was a problem. The people inside this system, brokers, bankers, investors, were rewarded for volume, not safety. If you could sell a loan, you got your commission. Whether the borrower could pay it back, that was someone else's problem. Soon, banks were approving mortgages for anyone who asked. No income? No problem. No job? Still no problem. They called them subprime loans, risky mortgages issued to people with little chance of repayment. But the banks didn't care, because they weren't holding the risk, they were selling it. And the more loans they sold, the higher their bonuses climbed. Wall Street couldn't get enough. They created complex new products, collateralized debt obligations, or CDOs, piles of risky mortgages chopped up and repackaged into layers, or tranches. At the top were supposedly safe investments, at the bottom, the dangerous ones. But the trick was this: even the worst loans were stamped AAA, the highest possible credit rating, by agencies like Moody's and Standard & Poor's. Those ratings said, "Don't worry, it's safe." And investors believed them. By 2006, more than $600 billion in subprime mortgages were being issued every year, and the world was addicted. Every bubble begins with belief. The belief that prices can only go up. By 2007, the housing market was soaring. Home values had doubled in some cities in just 5 years. People borrowed against their homes to buy more homes, to start businesses, to live beyond their means, because banks told them they could. But when belief meets reality, the crash begins. As interest rates rose and teaser loans reset, millions of borrowers suddenly couldn't afford their payments. Foreclosures surged. Home prices stopped rising and then started to fall. That one change, home prices falling, was catastrophic. Because the entire system depended on those homes always increasing in value. When they didn't, the foundations cracked. Mortgage-backed securities that once looked solid began to crumble. Banks realized the assets they held were toxic, but no one knew how much they were worth anymore. Confidence evaporated. And in global finance, when confidence dies, everything stops. By September 2008, Lehman Brothers, one of the oldest and largest investment banks on Wall Street, filed for bankruptcy. It was the largest bankruptcy in American history. Lehman had $600 billion in assets and $619 billion in debt. Within hours, the world's credit markets froze. Banks stopped lending to each other. ATMs almost stopped dispensing cash. The financial system, the same system that had seemed unstoppable, was suddenly on the edge of collapse. Panic spread faster than any virus. Markets around the world fell in unison. In just weeks, trillions of dollars in global wealth vanished. Ordinary people lost their life savings, their jobs, their homes. In the United States alone, nearly 9 million workers lost their jobs. Over 6 million families were forced into foreclosure. But this wasn't just an American tragedy. European banks had bought billions of American mortgage debt. When the U.S. housing market fell, so did their balance sheets. Countries like Iceland saw their entire banking systems collapse. In the UK, the government nationalized several major banks. In Greece, Spain, and Italy, debt crises soon followed, sparking years of austerity and unrest. Governments scrambled to act. In Washington, the U.S. Treasury launched the Troubled Asset Relief Program, or TARP, a $700 billion rescue plan to stabilize the banks. In theory, it was meant to prevent total collapse. In reality, it saved the institutions that caused the crisis, while millions of ordinary people suffered. The banks that had gambled recklessly were rewarded with taxpayer money, and almost no one went to jail. The same executives who built the system kept their bonuses. The same credit rating agencies kept their power. And the same political leaders promised reform while quietly ensuring Wall Street would recover first. By 2010, the economy was stabilizing, but trust in the system, in fairness, in accountability, was shattered. After the crisis, the world demanded change. The United States passed the Dodd-Frank Act, promising stricter regulation and oversight. Banks were told to hold more capital, reduce leverage, and limit risky trading. But behind closed doors, lobbyists got to work. Over the next decade, rule after rule was weakened, delayed, or repealed. The culture of risk-taking didn't vanish, it adapted. Instead of subprime mortgages, new speculative frontiers emerged. Crypto, shadow banking, private equity, complex derivatives that regulators barely understood. The same incentives remained. The same arrogance persisted. And in 2020, when the COVID-19 pandemic hit, markets once again faced collapse. Within weeks, central banks stepped in with trillions of dollars in liquidity, bigger than the bailouts of 2008. The system was rescued. Again. But not reformed. Today, the numbers are even more staggering. Global debt has surpassed 300 trillion, 3 times the size of the entire world economy. Housing prices in major cities are at record highs. Wealth inequality has reached levels not seen since the 1920s. And once again, speculation thrives. People trade digital coins worth billions on unregulated exchanges. Tech companies valued higher than entire nations burn cash chasing growth that may never come. Artificial intelligence, automation, and financial algorithms now make decisions once left to humans, but the incentives driving them haven't changed. If 2008 taught us anything, it's that greed doesn't disappear. It evolves. It learns. It adapts. And the same patterns reemerge. Easy credit, rising prices, blind optimism, and the belief that this time is different. But it never is. Even now, experts warn that new bubbles may be forming in housing, in corporate debt, even in government bonds. The triggers are different, but the psychology is identical. Behind every statistic is a story. A family who lost their home after a lifetime of work. A retiree whose savings vanished overnight. A generation of young people who entered the job market in 2008 and never recovered financially. In the years that followed, distrust in institutions grew. Populism surged. Political polarization deepened. From Occupy Wall Street to Brexit to global protest movements, the anger born in 2008 still shapes our world today. Because when people watch the powerful break the rules and get rewarded, they lose faith not just in banks, but in fairness itself. And that loss of faith is the true legacy of the 2008 financial crisis. So what can we learn from the crash that changed everything? One important lesson is that complexity is not safety. The more complex a financial system becomes, the easier it is to hide risk, and the harder it is to understand it. In 2008, even the experts didn't know what they owned. When fear replaced confidence, the illusion collapsed. Another key lesson is that incentives drive outcomes. When short-term profit is rewarded, long-term stability is sacrificed. Bankers didn't need to conspire to cause a crisis. The system's design made disaster inevitable. And finally, the next crisis won't look the same, but it will feel the same. Whether it's housing, crypto, or AI-driven finance, the mechanism changes, but human nature doesn't. The greed, the overconfidence, the belief in infinite growth, they always return. Today, the global economy is more interconnected than ever. Money moves at the speed of code. And the next crisis could unfold faster than any in history. Some economists warn that we're already living on borrowed time, fueled by debt, speculation, and complacency.
The question isn't if it will happen again, it's when. The 2008 crash wasn't an accident. It was a mirror, a reflection of human behavior under pressure, of a species convinced it could outsmart risk itself. And perhaps the most dangerous belief of all is that we've learned our lesson. To rebuild what was lost, we need more than new laws or stricter oversight. We need a cultural shift, a recognition that finance is not a game, but a shared responsibility. Because every system built on trust must eventually confront the same question. What happens when greed outweighs integrity? The answer, history shows, is collapse. But collapse isn't destiny. If the last century proved anything, it's that we can adapt, reform, and learn. The 2008 crisis was the price of forgetting that lesson. The next one will be the cost of ignoring it. If you found this story revealing, don't let it end here. Share it, talk about it. Ask why the system we all depend on still rewards the few while risking the many. Because understanding the past isn't about nostalgia, it's about survival. This was the 2008 financial crisis, how greed crashed the world. And the story isn't over.